What are binary options? Presented by WallStreetSurvivor.com and Nadex. Binary options are a form of options trading based on a single question. Did a stock index, commodity, or Forex pair end up over certain price or not by a defined time period, the expiration? Here's how it works. Here's Ben. Ben has been watching the price of gold for over a month, and even though its current price is $1,200, Ben believes the price will rally and be over $1,250 by the end of the week. With plain vanilla investing, Ben would have had to purchase gold or a gold alternative like an ETF or a futures contract. However, with binary options, Ben can simply make a prediction on whether or not gold will be trading higher than $1,250 by week's end, without having to acquire the asset. With binary options, there are only two possible outcomes at expiration. Either the price of an underlying asset, gold, finishes above the specified price at the specified date and time, or it doesn't. At expiration, the value of the binary contract is $100, referred to as an all-or-nothing high-low scenario. Back to Ben. So Ben believes the price of gold will be above $1,250 by the end of the week, so he decides to buy some $1,250 gold binary options. Contrarily, if he thought the price of gold would reach $1,250, he would do the opposite and sell $1,250 gold binary options. The trade price of a binary option ranges from $0 to $100 based on the likelihood that asset expires in the money or above the strike price, $1,250. In this case, the likelihood of gold reaching $1,250 is 60%, so the option sells for about $26. That likelihood is made up of a few variables, like how much the price fluctuates, volatility, the time until expiration, and the general market sentiment. Ben decides to buy 5 contracts at $60, so his initial cost would be $300. The maximum trade risk to possibly make $200 profit. Fast forward to the end of the week. Ben's premonition came true, and gold reaches $1,300. In that case, Ben's trade finishes in the money. Ben will make $40 per contract for a total of $200, as the expiration value will be $500 minus his $300 initial cost. Had the price of gold not cleared $1,250, Ben would have lost his entire $300 on the trade. The benefit of binary options is that they can be cheaper and potentially more lucrative than the alternative. For example, to buy a single ounce of gold, Ben would have had to pay $1,200, and Ben's return with binary options was a 67% return, even though the price of gold only rose by 8.3%. In this example, the binary is more lucrative, but it also has risk. Had Ben instead bought an ounce of gold and the price did not reach $1,250 by week's end, he is still left with a shiny ounce of gold. With the binary option, Ben would have been left with nothing but a $300 loss. For more on binary options, check out the Binary Options course pack on WallStreetSurvivor.com, brought to you by Nadex. Note, the examples in this video do not include exchange trading or expiration fees. Futures, options, and swaps trading involves risk and may not be appropriate for all investors.